When it comes to borrowing money, do you know what is your superpower? Do you know how much you can borrow and your monthly commitment? Join me and Vorleak today to learn more about your capacity.
Welcome to the Money DNA channel. Money DNA is a financial fitness community where we bring everything about money and beyond money concepts in life to help you create healthy money habits and to be financially fit for good. It is important to understand that the advice is general in nature and does not take into account your personal objectives, financial needs, and overall well-being situation, and it may not be appropriate for you.
Hi everyone, it's Winnie here. Thank you for tuning into Money DNA. We'll be looking at your capacity, your superpower as your income to identify how much you can borrow and your monthly commitment. Joining me today is Vorleak Srey at Veer Finance Advisory Services. Vorleak has been in finance and banking industry for 16 years. And in 2021, Vorleak brought her rich experience and knowledge and started her own business, Veer Finance Advisory Services, which provides various finance solutions and small business planning and advisory services to her customers. Vorleak, welcome to Money DNA again.
Thanks, Winnie, and hello to everybody again, and thanks to those that's tuning in once more.
Yeah, always love to have you on the show. So the last time we touched on with the second way out for the bank, which is, your collateral. That is what you can exchange to get a loan from the lenders and also the guarantors piece. And for those who haven't watched the videos, you can also check out the video here. But do you want to just quickly recap what we talked about last time about collateral?
Yeah, so last time we definitely touched on collateral and I guess your skin in the game as such in the form of cash, equity, guarantors, and we also briefly touched on lenders mortgage insurance as well. Both LMI and guarantors is really quite an in-depth topic that we just touched the surface on, so the tip of the iceberg, and it is quite broad. So I just wanted to say that if you are interested in learning more about LMI and or how it can help or impact you as such, then do let us know in your comments. And we can either do another episode or just contact Winnie or myself directly to talk more about your personal circumstances.
Yeah, definitely. And especially after the video recording last time, we too were just talking about so many scenarios and also so many stories that we come across when we are dealing with clients' situation. Definitely have a lot of things to touch on. So like V said, if you have any questions or if you want to know more about these two topics, do let us know. We can also organize another ad hoc or short sessions for us. So today we're talking about the second thing, which is capacity, your income, your superpower to identify how much you can borrow and your monthly commitment. And I guess that many people who are on this journey want to know, what do you mean by that as a superpower? And what can be considered as a capacity? And why is it so important?
I love that you use the word superpower, Winnie. Because it's a huge part of your lending ability as such. And I guess the term repayment capacity comes from the borrower's ability to repay debt over the agreed time with the lender.
Yep.
A lot of people going back to banking days when you and I used to sit together and talk about clients around what your biggest asset is. And a lot of people will go, well, it's my family home, or it's the cash that I've got in my account. It's my holiday home. But at the end of the day, your biggest asset is your ability to generate income. It's your capacity to repay. And without that, you can't really do anything. So it is your superpower as such in your financial life. So capacity can come in different forms, such as salary or your wages, your rental income from investment properties, dividends from shares, child maintenance, Centrelink, or even government pensions.
Right.
And so quite a few different things can form your capacity, but it's essentially your first way out of the loan. So it is a really important aspect of the loan application. If you don't have the capacity to repay the loan, then ultimately the loan should not be approved as part of the lender's responsible lending regulations. And they assess this through an understanding of a number of things. So your current commitments, or your other liabilities and debts, such as car loans, credit cards, your living expenses, or otherwise known as HEM, household expense measure.
Yep.
And then your proposed new loan repayments. And that is normally assessed at the bank's buffer rate, or what they call their affordability rate. All the above is then used to be minus from your income, whatever those forms of income are, to work out your capacity to repay.
Yeah, well, you just put general ideas about the whole capacity side. And I think that what I take away from that is we need to look at your income side of things. We also need to look at your expenses side of things. And I think that at the moment, why don't we just break it down into two pieces? But what I like about what you just said earlier is the biggest assets is not so much about our family home, it's actually the person. And that was the reason why that every time when we're talking about the fact that your income generation, which is yourself, is the most important thing, we also mention about things like, do you have any second plan, or what's your plan B? If anything happened to you, how are you going to ensure that you are going to still deliver the commitment? And that was a reason why when we are looking at a bigger debt or even a bigger liability or commitment to you, do you also have some insurance in place if that's going to be your plan B? And so don't really think that, it is going to be just another additional products for you. It's more about having a second thought about things. How are you going to make sure that along the way, when you are going through this journey, you also cover up with all the scenarios and also all the circumstances. So let's break it down into two then. Earlier you mentioned about the income. Why don't we start from income? So what type of income should we consider as a capacity?
Yes, I've touched on multiple different incomes, and it can, like I said, come from different avenues. It could be your business income if you're running a business.
Yeah.
It could come from your rental property if you've got investment properties as such that is being leased out. And most commonly is salary, though, salary based. Other things, like I mentioned earlier, is dividends, child maintenance, government pensions, job seeker, job keeper these days now in the COVID world.
Yeah.
Each income is assessed differently by the lenders, though. So the most important thing.
Yeah, so I was just thinking that earlier you touched on with so many incomes. Can we just say that one is, of course, how you are going to generate from your work? So the work could be from your business. It could also come from your full-time job or part-time job. You also touch on with the like rental income and also dividends and everything. That will be the investment income. And then also there are going to be some secured income, which is from Centrelink or government pension, whatnot. And also some of the support. So I guess that probably is going to be a couple of the categories that we can discuss. But you also mentioned that with a different income, of course, the lenders are going to assess that in a different way. So do continue.
Yeah, so thank you for breaking that down, Winnie. And income, you can have multiple income streams. So just because you have a business, it doesn't mean that you can't also have a salary or income coming from investment properties.
True.
So yes, lenders do assess it all very differently. And the most important thing to remember is, just like anything in life, is how sustainable is that income? That's what the lenders are looking at. So how consistent it is, and the likelihood of the income ever ceasing, and hence the reason why it's assessed differently at different risk levels. So for a salary, so for a salary or a wage, for example, if you're a full-time employee, then most lenders would go, 100% of your income. If you're full-time, within 3 to 6 months, we'll take everything, as long as you're not on probation probationary period. If you're casual, for example, then it'll be 12 months post commencing your job that a lender would look at you, because with casual work, you're not always guaranteed the same amount of work. Your hours can change at any point in time, and hence the reason why they want to see that 12-month history to be able to average it out and be able to utilize that income for your servicing.
I see.
So as a permanent part-time, generally it's about 6 months of employment. For say overtime or penalties that you might earn, some lenders will only take around about 80% of that income, and it needs to be evidenced over a 3-month period. So during that time, so for example, let's say your monthly income is $4,000 a month in terms of your salary. But over the last 3 months, you've earned $15,000. So $12,000 of that is your salary, your base. The other $3,000 is your overtime. That overtime then is shaded at about 20 to 30%, meaning that the lender would only then utilize $2,100 out of that $3,000 to service your loan application. That's not to say that there are lenders out there that would take 100%, but majority of the mainstream lenders would take a haircut out of that value.
And rental income, what you just said, that with the income, sorry to cut you, so with the income, obviously as a full-time base income, that is the most secure things for the lender to consider. But then there are going to be some other package that you part of the income that you receive from your package, like earlier you mentioned about overtime. You are not going to have overtime all the time, so of course the overtime cost or the income will have to share away a certain percentage. What about some of the leaves or like bonus? You know, sometimes we do have the quarterly or the yearly bonus. How is the lenders assess that?
Yeah, so that's a good question, and it all goes back to, again, sustainability and consistency of that income. So, you know, there are roles out there where people would earn a generous amount of bonuses every year, and, you know, commissions and stuff like that. So those are assessed, again, differently by the lenders, because if you have a really bad year, you might not get a bonus. But if you have a really great year, then your bonus could be quite substantial. So they would look at that over a 12-month period, over 2 years for bonuses, and then average it out. So you've got to better prove to the lenders that you're consistently getting these bonuses over 24 months.
Right. Okay. How are we going to prove that though? Do we need to give them a tax return, or do we need to give them a bank statement?
That's right. So most of the time when it comes to bonuses and commissions, lenders will look at your tax return over the last couple of years or your notice of assessment, and utilize that minus your base full-time salary income.
I guess that makes sense, because that's the reason why when we are going through the lending process, the banker and the broker will request so many different documents. It is actually to prove your capacity in so many different ways. So like tax return are going to see all your incomes, including your dividends, your rental income and whatnot. But at the same time, your employment condition is going to allow you to know about the total income you got, and then break it down into small pieces so that you are going to be able to assess that. Is that what you are saying?
That's exactly right. Yeah.
Okay. And then what about other things though?
So same thing as rental income. Generally the lenders would take 80% of the income, so, you know, shading it by 20% or so. And this is because, again, typically the lease of an investment property is 12 months. And then post that period, the market can change, so it can actually decrease, or, you know, it can increase. But what the lender is doing is mitigating their risk in case of a market change for it when it does decrease, or for when the lease is over and it might take some time to relet the property, where there's a period of time the property is vacant, and hence the reason why they compensate by, I guess, providing what the bank calls their bank haircut or bank value.
Yeah, I have to say that there are so many times I have a conversation with the clients and they said, hey, see, this is the proof of the income that I received in the last 12 months from my rental income. Yes, I see it. But at the same time, this is the way that we assess that. So we need to give them a little bit of educational session with the clients, let them understand that about that, even though this is going to be a fact, but because it's not going to be a consistent thing. And this is the way that lender is going to assess with your income, especially with that pace. So I guess that now we cover pretty much all the income streams. Let's talk about the expenses. Earlier, you also mentioned about HEM, H-E-M. So I guess that one of the things I will be interested to know is, we're all different and we have different lifestyle, different expenses. Are we going to have a standard rate for our expenses, or are we going to just see as, an individual scenario?
Really, really good question. And this topic, or HEM, or otherwise known as GLE as well, which is just bank jargons for pretty much the same thing. GLE, G-L-E, is general living expenses. HEM, H-E-M, being household expense measure. So living expenses are the costs that you simply just cannot remove from your budget. In other words, the form of spending, it's reserved for providing you with a basic standard of living, including food, water, clothing, electricity, healthcare, insurances. So you'd have your fixed costs and your variable costs, and your variable costs being, say, like, going out, having dinners, drinks with your friends, and maybe shopping for that new cute dress because you want to spoil yourself. Whatever it might be. Yeah, so regulators and the banks, they work alongside each other, and they conduct studies on typically like a yearly basis on stats of what the Australian household living expense measure would be. And it's based on those, I guess, the fixed overhead. So, to live in Australia, typically how much would you need to pay for food? How much is water costs? How much is it, to have power, and all these types of things. And the postcode that you live in can also dictate your HEM expenses declared to the lender.
So that's quite interesting. Now, you are saying that it is actually the stack numbers that the government come up with, or the studies research have this kind of conclusion. But at the same time, postcode is going to be one of the consideration that they have. What about how many people in the household? Is it going to impact on the living expenses as well?
Most definitely. So you would expect that a single person with no dependents living on their own would have less expense than, say, a couple with 2 children. And a couple with 2 children would be expected to be spending a lot more living expenses, such as food, because you're feeding a family of 4 versus 1. School fees might be applicable, childcare, nappies, all those things. So yes, your marital status also plays a part in your living expenses. If you're single versus a couple, then single, you tend to spend less. If you're a couple, then you're likely to spend more, even if you have no dependents, purely because if you're going out together, you might be covering each other's expenses. Everything's pretty much double in that scenario.
Yeah, now it makes much more sense now, especially when I look back to, when we're going through this application. Usually you will start with engagement with brokers or the bankers by having the discovery conversation. And with that discovery conversation, you have to fill up all the information, providing all the information to them as well. One of the questions they are going to ask you is, where's your postcode? Are you married? How many children or dependents you have? Also asking you about the general living expenses, and most of people wouldn't even have a clue about how much expenses they have, so they just come up with a summary. But at the same time, what the banker and the broker would do is ask you to have the bank statements provided to them, so that they are going to also assess about the actual expenses you have. But at the same time, they also have some sort of a standard like HEM and GLE that you just mentioned, so that they are going to weigh it up with things. So what happens if your living expenses is lower than the HEM then?
Yeah. So the HEM, we can never really determine the exact amount because, as I said, it's really determined by, I guess, the postcode, the area that you live in, your actual your marital status.
Yep.
But let's say typically, from my experience, a single person with no dependents, the HEM, or what the bank would call the poverty line in terms of living expenses, is generally around 1,500 to 1,800 a month
Right.
that we would expect a single person to spend to survive. So it's not to say that you cannot live under those means. For example, a family with four, it's expected they spend at least 4,000 to 500 plus on living expenses. And this is not including your rent. This is pure living expenses. But you can have, for example, going back to what you were saying, that, we're all really different. We have different living situations, we have different values, different living arrangements as such. So a family of four can spend $2,000 a month, which is half of what HEM or the Australian standards are. You could have a wife that stays at home. That means that then there is no childcare fees. The kids could be attending public schools, in which case there's no school fees as such. Meals are cooked at home, for example, so that becomes obviously much cheaper and they barely go out. The family could be vegetarians for all we know, in which case food costs are much cheaper because you're not having to pay for meat. Both parents do not smoke, they don't drink, which then really drastically reduces your living expenses. So obviously the example I've given you is quite stringent. You get the gist. So in this scenario, if you're declaring that your living expenses is well below the HEM, then the lender as such would peruse your statements to evidence that. And typically it's about 3 to 6 months into understanding whether it's true and correct.
So I guess that what you are saying is obviously with that standard, this is what they stand for, but at the same time, there is still going to be some flexibility as long as you are going to prove that this is actually the fact. And I guess that especially COVID really challenged us to rethink about how we live our life. So I think I saw so many people starting to go to like bunnies and then going to different places and then look at having their own garden patch at the back of their backyard, or starting to be self-sufficient. So maybe the living expenses are going to be quite varied afterwards, but who knows. But at the same time, if you are not really sure about that, make sure that you are going to monitor your living expenses from time to time. And I guess that if we're going to really wrap up with what we discussed today, we talked about one of the key things when we are looking at your lending process, which is your superpower, your income, your capacity. It is the way that you are going to pay the loan back as your monthly commitment, monthly repayment. But in order for you to make sure that this process are going to be smooth as possible, you need to make sure that you're having a really good money habit, and also make sure that your cash flow is going to be comfortable as you are. If you do need to have someone to really support you on that, and that's where V and I are here for. So what's your key takeaway, V?
Yeah, so I guess going back to our initial episode, Winnie, on character, where if you're changing jobs all the time or moving from different places to places, it can really impact your ability to get a loan. So potentially, if you are changing jobs all the time, you might need to wait 18 months before you can apply for a loan as such, going from, say, full-time to casual. So it is really important to see a specialist, so a broker like myself, and also Winnie, so you understand your personal situation and understand the impacts it will have if your goal is to purchase a new property or secure a loan, whatever it might be. But it might just mean that it might take 3 to 6 months to get you ready to your next goal. And having that support and the genuine savings history in place is so important. And I know that you've been able to do that for a lot of my customers in the past.
Yeah, and we can definitely see the impact on them, which is really awesome to see. So really great conversation today. Thank you, V, for sharing your knowledge and also your passion with us again. So next time, what we're going to talk about is actually the process. I know lots of people wanting to know about step by step, and having you to walk their this journey with them is going to be so important. So next time, what we're going to discuss is how many steps are we going to go through in this process before and then during and after. So if you like what we share and or you think that someone may benefit from the content, please like, share, and subscribe our channel. And if you like to book into the complimentary consultation about your money DNA, or you'd like to contact V to discuss about your lending needs, the link and the contact detail will be captured down below. You can also leave your questions or comment below and it will come back to you as soon as possible. Thank you for joining us today. Please keep financial fit and healthy, and we'll see you next time. Bye.
Thanks, everyone.